Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200, as well as copper, gold, oil, and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only and doesn't take your personal situation into account. With all of that said, let's get into our first chart. So I've got the S&P 500 on the screen, and it looks like the S&P 500 is completing another brief consolidation. So this series of higher lows and higher highs continues to dominate the price action, and it's interesting because we do hear a lot of chatter about it's just seven stocks. It's just seven stocks driving this market, and I'm not quite sure that's entirely accurate. What's interesting to do is to look at the S&P 500 on an equal weighted basis. So this is an S&P 500 equal weight ETF. And when you do that, you'll see that on Wednesday, because I'm recording this on Thursday Sydney time due to the Easter long weekend, on Wednesday, the equal weight made a new all-time high. So there's the previous all-time high. It had made a new all-time high a week or two ago, but it's made it again. We've got another all-time high in the equal weight. So I think this really is a broad-based rally, and this is I think this is a really important component of a bullish market, that a rally is broad-based. It's not just a handful of stocks that are driving the price action. And this has been, just coming back to the S&P 500, this has been an exceptionally strong run that the market has had. Just looking at this 50-day moving average below, so I've got the 50 and the 100-day moving averages. So the S&P 500 hasn't touched this 50-day moving average for nearly 5 months now. And it actually is rare to get these long runs without a touch of the moving average, but they do happen. So the last time was back in 2017. So let's just jump back. I'll show you 2017. So this is the last time we had a run of this length. So it's this period, which you can see on the chart now. So this was the length of this run was about a week longer than where the market currently is. Now, of course, you can see this scary decline at the end of the period. That's not the point of showing you this. I'm not suggesting that's what we're heading for at the moment at all. It's the point to show you is that you do get these long runs above the moving average, but they don't happen that often. The price action in this period, it's a bit different. It's a bit different to what we currently have, in that the final month there was a real acceleration to the upside. We haven't seen that in the S&P 500 at the moment. The S&P 500 at the moment looks more like this phase here, where it's just persistently staying above. Doesn't have that acceleration kick higher. That's not to say it won't happen, and if that happens, well, then maybe we will be talking about, be careful, because these things that accelerate can come back quickly, but that's not where we currently are. The point is, these markets can stay above the 50-day moving average for a while occasionally, and we're in one of those periods. Before this, you've got to go back to 2007. So as they say, they don't happen that often. And as I say each week, I think the most appropriate strategy at this point in time is to let profits run. So, sure, prices have come a long way, but there's nothing to say they can't go higher. It's prices had come a long way in January and in February. So, and they've continued to go higher. So no one knows where a trend's going to end. So I think the way you maximize your profits and maximize your performance is to just let those profits run. When something is working, let it keep working. I think the mistake that we see a lot of people make is they try calling tops, and we've seen calls for this market to peak pretty much all the way up. And the bears have been there too, saying this isn't sustainable, it's going to crash. So there's all sorts of opinions out there, But the simplest approach has been to buy once the market got it back above its moving average, buy into the strength, and then let those profits run, and not trying to get too clever by trying to call tops. And and the problem with doing that is you're predicting something that is working is going to stop working. And I think just keep it simple. If it's working, let it keep working. If prices are going up, then stay on for the ride and see where they go. Of course, we always need to consider risks. So it's not just a blind process of the market's going to go up. We've always got to consider that risk. For me, that involves using wide trailing stops. I want to keep that upside open, but have an exit point if a pullback develops that turns into something bigger. So a wide trailing stop can help see off these moderate. Oh, this is moderate. This is a modest consolidation, but a wide trailing stop can help you see off something a bit larger than that, and keep you in the trend. But if things really do deteriorate, well, those trailing stops can help get you out. I still find it hard to buy the S&P 500 index at current levels. Yes, everything I just said then, I think the trend's going up. I would want to be holding positions, but it just doesn't, as an entry point, it doesn't have the asymmetric properties I like. It doesn't mean it won't keep going up, but I'm always balancing risk and reward. I've got to see the reward as being a multiple of my potential risk, and I just don't feel the right properties with an entry point at these levels. My preference for getting money into the market, well, it's through the individual stocks breaking out of ranges, stocks which are rallying off their moving averages. I'll show you what I mean by that in a moment. If you're getting value though from this video, please hit that like button and please leave a short comment. Helps a lot because then YouTube goes and shows other people, and really it helps me heaps because if people are watch these videos, I keep making them. I've got to have that audience. So yeah, please give YouTube the right signs that the stuff's worth watching. Now, I want to finish up with, I want to move over to the small caps, have a look at the Russell, because this continues to build nicely above this 50-day moving average. And it's currently just below the March high. So look at the current price action from Wednesday's close, just below the March high. By the time you watch this, I think there's every chance it'll be above the previous high and making a new high. I like that. There appears to be accumulation on pullbacks, and we just look at the pullbacks of the 50-day moving average. Every time we pull back, there seems to be that accumulation. And just in the last few days, a shallow pullback, accumulation, and now a push to the upside. So I think that's encouraging price action, and I think it's the sort of price action which could lead to an acceleration. And it's like we've got this big basing formation, which the Russell's been trying to inch its way out of over the last few months. It's been edging its way upwards out of this range, and we could be about to see the point of recognition where prices, we do get that decisive break to the upside and some sort of an acceleration. It's I think that's the potential in this current market that I'm watching. Same goes for the micro caps. If we go to this micro cap ETF, the iShares micro cap ETF, it's the same general structure as the Russell. It's a bit different, but it's generally the same in that it's been building along this rising 50-day moving average. We've got that series of higher lows, of higher highs, and it gives the impression there's pent-up buying demand, which really could release to the upside, and we do have that potential of an upside burst in this smaller end of the market. I like the risk reward dynamics of the smaller companies, and I think there's good upside potential from current levels. I feel the risk reward can be better managed with this at this end of the market than at the S&P 500 after its long run above the 50-day moving average. As always, I don't want to lose sight of risk. I want to continue playing. Want to continue playing this from the long side, but just want to be selective about the stocks that I buy. So I'm looking at stocks on an individual basis. I want to be buying stocks which are above their moving averages, or if I'm playing the index, well, I want to be trading it whilst it's consolidating above these rising moving averages and breaking higher, and then knowing where my exit points are should things take a turn and start to head lower. It's there's never a one-way bet in these markets. It's know where your risk point is, and then also know your upside potential and be willing to let that upside run when things are working. So look, hopefully that has been interesting. I think we will leave it there for this week. And look, thank you for joining me. I look forward to coming back and talking to you next week. Till then, bye for now.